Hmm. So, a very good morning to all of you. And like today's session is a continuation of our previous session. Like as we have discussed in our last session, that there are basically five heads of income, which are your salaries, your income from profit and gains from business or profession. Then we have capital gains, and we have two more sections, like we have income from other sources, and we have this income from house property. Okay, so the most common head which is used in our computation, it is your income from the head salaries. And the salary head, it includes your income from pension also if you are a retired person, right? So the salary income, like during the tenure of your job, whatever income you receive as a compensation, that is included as salaries in this particular head. And as soon as you retire and you get some compensation from your ex-employer, then whatever pension you get, that is also clubbed under your income from the head salaries. Okay, so like this particular head, I think that is very important for your practical knowledge also, because you will use this knowledge in your real life. Now, whether you are maybe in the future, if you're negotiating your own salary or structuring compensation for your teams, if you are an entrepreneur or you are a senior, then also this particular head of salaries will be very, very helpful for you. Now, uh, let's understand. We are going to have a quick revision of what we have done in the last session, and then we are going to move to the remaining topics in this particular chapter. So, what is salary? Okay, so salary is a payment received by an individual for the services rendered under an employer-employee relationship. Okay, so for example, there is monthly wages, there are bonuses, there are commission, there are pensions, there are annuity paid by employer. So all of these are salaries. Okay, all of this is a part of your salary income, right? So when for example, like when I received my first pay slip, I was really surprised to see so many components. Like there was this basic, there was HRA, there was a special allowance, there were deductions, and then every element, it had some separate sort of tax implication. Now the thing is, because I already had this knowledge of finance and taxation, so I was able to understand it in a practical way. But if someone who is very new to this field, they'll not understand it unless and until they study about it. Okay, so now um, if we see now going forward, when you guys will be seeing your salary structure, or you will be working on some task related to salaries, then it will be really easy for you to understand all of that and implications of all those elements, right? So this particular chapter of salaries, it will be very helpful in your practical life also. Or and if you see salaries, as I've told you, there are various components to it. We have something called basic salary. Okay, that's the foundation. That's the biggest chunk of your total salary, basic component. Okay, so all the other allowances and benefits, they are usually, you can say, calculated as a percentage of this basic salary. Okay, then we have allowances. Okay, we have house rent allowance. Now, these are all these allowances are something which you get apart from your basic salary. Okay, and all these, usually these other allowances, perquisites, they are usually in proportion to your this basic salary. Okay, so that is why it is that, as I mentioned, that basic salary is usually the foundation amount. Okay, foundation, like the basic amount, basic salary, right? So we have something called house rent allowance also, which is part of your total salary. Like house rent allowance is basically, it is available for those who stay in rented accommodation. And if you submit the documents of the proof, or you can say the rent receipts, then you get a deduction for it. Now the tax will not be charged in that if you show the tax receipts. Oh, sorry, the rent receipts. Okay. Then there is something called dearness allowance, which is also a part of your salary. Now, dearness allowance is something like it compensates your salary, or you can say it adjusts your salary against the inflation. Like whatever is the inflation going on in the economy, your salary is increased as per that because inflation is increasing day by day. So your salary is also adjusted to match up with that rising inflation. Then we have something called, you can say, travel or transport allowance and that is for commuting, like coming from home to office and to and fro. Okay, so there is something called transport allowance. So the point is that the employers usually give you a lot of allowances also apart from your basic salary, and all of that together it comprises your this you can say your total in hand salary, right? So that is the thing. Now we have you can say perquisites also, which are part of your salary. So perks are like they are kind of a non-cash benefits. Okay, they are kind of a non-cash benefits like company car. Then you are getting rent-free accommodation. Then you are getting subsidized. Okay, then you are having meals in the office. Then loans and concessional rates. So all of these are perquisites. Fine. Then there are certain retirement benefits like we have PF, gratuity, leave encashment, and especially when you are the now a knowledge of these things like retirement benefits, that is very important when you are switching a lot of jobs because these particular funds they are moved from one company to, or you can say account of one employer to another employer. Okay, so we were understanding this salaries. So we have also discussed like if you see that there should be an employer-employee relationship to include a particular amount in your salaries. So the existence of an employer-employee relationship is really essential for income to be taxed under the salaries head. Then remuneration received from any source other than employment will not be taxed under the head. Okay. Then there is this place of accrual or receipt. Now, this is very important because if you remember the concept of that non-resident or not ordinarily resident, at that time, we have discussed that how important it is, the location and the duration you have spent in a particular country, that all of that is important to basically assess the taxability of income in that particular nation. Like whether you want to um, tax that particular income in your nation or not. Okay. So place of accrual or receipt. So salary is taxable in the previous year when it is either received or becomes due, whichever occurs first. So for example, if we are in the month of now we are in the month of August. Okay. Now many of salaried professionals they will be getting the salary of July month on 1st of August. Okay. And so your salary of July will be taxed in the month of July itself because it was accrued in the month of July. Fine. Now, today you receive the salary of August also. You get a 2 month salary. So, will you tax that August salary in the month of September or today or at the end of the month of August because it is still not accrued, but you have received it. So, the point is that the taxation will be either receipt or accrual, whichever occurs first, whichever is earlier. Okay. So for the July salary, it will be taxed in the month of July itself because it was accrued earlier. July month has passed. It was accrued also at that time. So it will be taxed in the month of July. But the salary of your August will be taxed today only. It is still not accrued because the month has just begun. Okay, so we are going to tax your August salary today, not in the month of September, not at the end of the month of August. Why? Because either receipt or due, whichever is earlier. So receipt is earlier. So we are going to tax it today. Okay. So this is the thing. Then place of service. Like salary is taxed based on the place of employment. Salaries earned for services rendered in India are taxable in India, regardless of whether the payment is made in India or outside India. Okay. Then, as we've discussed, that components of salary. So the salary head, it includes your basic pay, your bonus, wages, fee, commission, allowances, perquisites, profit in lieu of salary, and contribution to provident fund. The taxable amount of all these components are considered along with the deductions under the head while calculating the taxable salary. Okay. Then salary paid by foreign government. So any salary paid by the foreign government to its employees serving in India is taxable under the head. Okay. Then foregoing of salary. The salary which has been earned by an employee, it is taxable in his hands, though he may subsequently waive the right to receive it. The waiver of the salary is application of income. So, for example, if someone says that, okay, I don't want to receive my salary, so that doesn't mean that you will not be liable to pay tax. Because waiver of salary is like, for example, if you say that, okay, I'm not going to take up my salary, give my entire salary to Mr. B. So will I be escaped from the taxation liability? Or Mr. B will be asked that, okay, you are taking the entire salary, you pay the tax. So that is not possible. Waiver of salary is not at all possible. Okay, you have to pay the tax because after that you can obviously applicate that you can basically give it to someone or basically whatever application you want to do out of your salary. Okay, but the thing is that the person, the employee, he is liable to pay the tax on the salary. Fine. Then there is this concept of surrender of salary. So any salary surrendered by the employee to the central government under the voluntary surrender salaries act will not be taxable in his hands. Okay. So that is again the concept for surrender of salary, that it will not be taxable in the hands of the employee. Okay. Then there is this tax-free salary, that when the employer pays the tax on the salary of the employee, then the amount of tax paid by the employer shall be taxable in the hands of the employee. Okay. Now, remuneration received by officials of embassies is exempt from tax. So, who are these officials of embassies? So, those officials who are posted in different country. Okay, they represent our country in the foreign embassies. Their salary is exempted from tax. Okay, so these are basically, you can see a few examples where the salary is exempted from tax. So non-citizens who are non-residents and they're receiving salary for services rendered in connection with employment on a foreign ship are exempted from tax in India. Subject to that, his stay in India is up to 90 days. So that is basically non-citizens. So these are few of the individuals who are basically not at all they are paying tax on their salary. Okay. So some it is like if we see different heads of income, if you remember, then at that time, like in the first module, we have studied agricultural income. So that is also exempted from salary. Okay. Then there is this, okay, so this is very important. There is a standard deduction of 75,000, which is mm, available these days if as of assessment year 25-26, which is very helpful for the salaried individuals. So the standard deduction, you can say in this in income tax, this basically it is an exemption given to you from your entire salary income, irrespective of your total income. Okay, so there is a fixed deduction allowed from your, you can say, salary income to reduce the taxable portion, and this eventually results in you can say lowering the tax liability for salaried and pensioned individuals. So as per, you can say, the like the union budget, it was there in March. Okay, the standard deduction has been enhanced to rupees 75,000. So earlier it was 50,000. So there was a very significant increase. If you see, there's a 50% increase. Earlier it was 50,000, now it is 75,000. Okay, so all the salary taxpayers and pensioners, so from the assessment year 25-26, they will be eligible for a standard deduction of 75,000. So this standard deduction is available. You can say like there are two regimes in taxation. There is this old regime also, and there is this new tax regime. So this standard deduction, you can say it is available under both the regimes, be it your old tax regime or new tax regime. So initially, like in the new regime, it was excluded, but subsequently there were certain amendments made, and which basically started we like the government started giving exemption, or you can say deduction, under new regime also. Okay, so if someone who is filling his income tax return, so there is nothing like you don't need to submit any bill, you don't need to submit any proof or invoice to claim it. It's like automatic. It happens automatically. That this deduction is available automatically to all the salaried employees, and like who are getting Form 16. Okay. So for most employees and pensioners, the standard deduction is the first line of reduction in taxable income. That's the first deduction you get while filing your income tax return. So standard deduction is definitely, I think that's a very important question also. So this is a very MCQs can be asked on this particular thing, that what is the amount of standard deduction? Okay. Then there is professional tax. So professional tax, if paid by the employee, is allowed as a deduction from the salary income. Then there is this entertainment allowance. So for government employees, a deduction or entertainment is allowance is available subject to certain limits. Okay. So some employees, they receive graded system of salary. So graded system of salary is basically there is a pattern to it. Like your salary begin with 12,200. Now there's going to be an increment of 300, for example, per month, until your salary reaches 17,500. So every month 300, 300, 300 plus will be added. It can be annual also. So grading system, it depends what kind of grading system is, but it is usually read as like this. Like it is written 12,200 dash 300 dash 17,400. That means you keep on increasing your salary by 300 until it reaches 17,500, 17,400, and after that your that particular increment, it will be 500 until it reaches 19,400. So this is the way this grading system works. Okay.
Yeah.
Now there are certain allowances like dearness allowance. These are basically so what are basically allowances? I think we have covered a couple of allowances in the last session. Like there are various types of allowances. Like we have dearness allowance, we have overtime city compensatory allowance, we have medical allowance, we have transport allowance. So there are various types of allowance. All of them are fully taxable. Fully taxable. So basically, what are allowances? Let me explain you in very simple terms. So allowances are, first of all, they are some type of compensation given to meet a particular nature of expense. That is allowance. Okay. They are for specific needs. For example, dearness allowance is to compensate for inflation. Okay. So there are fully taxable allowances, like we have dearness allowance, so it compensates for inflation, like it is 100% taxable. Then we have overtime, city compensatory, servant allowance, and interim allowance. So all generally fall under the fully taxable category. Then we have partial exempt allowances. So we have house rent allowance. So it is partially exempted. if you pay rent and you meet certain conditions. Okay, so that is house rent allowance. Then we have leave travel allowance. So it is exempted for travel within India subject to limits and conditions. Okay. Then we have something called children education allowance. There's a list of allowances which are offered by the employers. Okay. So there is some children education allowance which is for supporting the education of the kids, and that is up to two kids. Okay. So that is something. So we have hostel expenditure allowance to meet the hostel expenses of your kids. Then we have conveyance allowance. So there are multiple allowances which are given by the employers. So these are fully taxable allowances. Like we have dearness allowance, we have city compensatory allowance, we have medical allowance, transport allowance, stipend allowance, overtime allowance, non-practicing allowance, family allowance, and overtime allowance. Okay, so these are your fully taxable allowances. Okay. Now there are certain allowances which are exempted to the extent they are spent. So we have traveling allowance, we have daily allowance, we have conveyance allowance, we have uniform allowance, we have research allowance. So these are then we have helper allowance also. So there are various types of allowances which are to a particular extent they're exempted. Like for example, if your employer gives 1,000 rupees per month for a particular allowance, and it might be exempted, like 800 rupees will be exempted. So 200 will only be taxable. Okay. So for that 800, you need to give some that proof. Okay. So there are so the thing is that the employer give you a variety of allowances, and out of those allowances, few are fully taxable allowances, and few allowances are there which are exempted to a certain extent, like whatever is your expenditure. Okay. And to prove that, you have to give but that receipt. Okay. So this is basically the chart for your exemptions of allowances. So if you see house rent allowance, so minimum of the following will be exempted, like actual amount received, minimum of the following. Okay, so it's for house rent allowance, actual amount received. And second is your 40% of salary or 50% for metro cities. Then rent paid less than 10% of salary. That is thing. Then we have children education allowance. So 100 per month per child, maximum for two children. That is your children education allowance. Then we have hostel expenditure allowance like 300 per month per child, maximum for two children. Okay. Then we have transport allowance for disabled employees, that is 3,200 per month. Then we have transport allowance to employees of transport system, which is 70% of the allowance received or 10,000, whichever is less. Okay. Then we have tribal area allowance, which is, excuse me, which is 200 per month, and that is only in tribal states. That's very rare. Then we have underground allowance, that is 800 per month. Okay. Then we have compensatory field area allowance, that is 2,600 per month. Then we have compensatory modified field area allowance, which is 1,000 per month. Okay. So these are basically the exemption amounts. Okay. Now these exemptions are also subject to the receipts which you provide to the employer. So now these are a few fully exempted allowances. So there are certain allowances which are wholly exempt under the old tax regime as follows. So allowance to high courts, like we have Supreme Court judges, employees of United Nation organization, and sumptuary allowances to High Court and Supreme Court judges. So okay, so allowances which are fully exempted under both regime. Okay, so allowances payable outside India to the government employees who are citizens of India by the government of India. So these are fully exempted allowances. Okay. Now there is the next thing which is called profit in lieu of salary. So sometimes you get a benefit from your employer which is not a part of your regular salary, but it is still included in your salary itself. Um, so this is basically you get certain type of profit. Okay, so let's see what is this. It refers to the benefits received by an employee from their employer that are not part of their regular salary but still treated as taxable under the head salary in the income tax. So these are payments due to termination of employment, then employer contributions to unapproved funds exceeding specified limits, then bonuses, commissions, or purchases. Okay, so these are basically profits in lieu of salary. Okay, so this is you can say this is a when we see the computation of any employee, we have to be very careful that is there any component of profit in lieu of salary, because these payments are slightly different in nature, because they are, you can say, a kind of payment received by any employee in instead of your addition or instead of your salary or wages. Okay, so they are though they are apart from your wages or salaries, but they're still included in your salary. So you can say that these are a kind of benefits, amounts, or compensations that an employee receives instead of salary. So the law ensures that even if your employer does not call it salary, but it pays you compensation because of the employment relationship, so it still gets taxed as salary. Okay. So typical if you see the examples, we have compensation or payments received at or before termination of employment. So for example, there are certain sort of retrenchment compensations which are basically given at the time of resignation or retirement. So that is your that is also part of profit in lieu of salary. Then there are certain payments which are from an employer or some former employer also, like any gratuity which is paid to you beyond your exemption limit or beyond your pension. So that is your this profit in lieu of salary. So there are various things like any sort of contribution made by your employee to an unrecognized provident fund, which is beyond the allowable limit. They are voluntarily paying extra into your provident fund account. So why will they pay extra? If they will pay extra, that is going to be considered as your income. Fine. So that is profit in lieu of salary. Okay. Now there is something called gratuity. So gratuity, I think we have discussed all of these things we have discussed in short in the last session. So what is gratuity? So gratuity, first of all, it is a kind of a retirement benefit that when you retire, or there is you can say uh, not only retirement, but if you complete a certain period as a job under a job and then you leave that job, then you are eligible for gratuity. Okay, gratuity you basically get at the time of termination or you get at the time of retirement. Okay, so gratuity, it is a kind of a lump sum payment that you get a chunk of money, 20 lakh, 50 lakh, 60 lakhs, depending upon the amount of like a tenure in that company. So gratuity, it is a kind of a lump sum payment made by an employer to an employee as a token of gratitude for services rendered. So it is typically, you can say, payable on termination of employment due to retirement, resignation, death, or disablement. So that is gratuity. Then we have like gratuity is also like there are certain tax limits, or you can say tax exemption limits are there under gratuity that you get a certain amount of exemption from that amount. So there is very detailed analysis of that. Like there are certain categories. Like if the employee is covered under the Payment of Gratuity Act 1972. Now that is generally in private sector employees in organizations with having more than 10 employees. So they are basically covered under Payment of Gratuity Act 1972. Okay, so one thing apart from our discussion, like I want to share, like when you study tax, what happens is you will face a lot of new things which you've not never heard about earlier. So why this happens? Because taxation is basically application of other acts. Income Tax Act in itself includes application of various acts. Like there is this, like I've just told you that there is some act called Payment of Gratuity Act 1972. So under your Income Tax Act, we are going to see the application of that Payment of Gratuity Act, that how it is actually getting applied in the tax computation of a salaried employee. Okay, so there are very, you can say it is a very broad subject and it keeps on changing every year. Or you can say many times between the year also, like constantly we keep on getting amendments, constantly we keep on getting changes in the Income Tax Act. So that is why it becomes really difficult for professionals to keep up with the changes which are coming in the field of Income Tax Act. So it is very important, like even I am a tax professional, so I need to keep on studying the taxes, like what are the new changes, new rules, regulations which are there, so that we don't compute the tax in incorrect way. Okay. So under the Income Tax Act, gratuity received by an employee, it is exempted from tax to the extent specified by law. So for employees covered under the Payment of Gratuity Act 1972, generally private sector employees in organizations with 10 plus employees. So the gratuity exemption limit is the least of, you can say, actual gratuity received, 15 days wages for each completed year of service based on the last drawn salary, or rupees 20 lakh as per the, you can say, the latest ceiling, including the year 2025. Okay. So for government employees or you can say employees of certain other notified organizations, gratuity is fully exempt irrespective of the amount. Okay. So for employees not covered under the Payment of Gratuity Act, a different limit applies. So the least of actual gratuity, that is 20,000 per year of completed service or 15 days wages for each year of service. Okay. Then we have salary for gratuity calculation also. So salary for gratuity calculation, it includes basic salary plus dearness allowance. So this forms the basis for calculating the wages. Okay, so salary for gratuity calculation is also there. Then we have taxable portion, like if gratuity received, it exceeds the exemption limit, like the excess amount is treated as taxable income under the head salary and taxed according to the applicable slab rates. Okay, so these are basically the limits which are there. So let's see what are the limits. Government employees or member of civil services and local bodies, it is fully exempt from tax. Then we have other employees, or this Payment of Gratuity Act 1972 applies. So least of the following is exempted, like actual amount received, salary of last month into 15 by 26 into service period in years. Yeah, or you can say 20 lakh rupees. Then notes is like salaries is equal to basic pay plus DA. Okay. Then while calculating service period in years, part of the year which is more than 6 months shall be taken as 1 year. For example, if you served for some 10 years, 8 months. So that will be considered as 10 year. You can say basically it will be considered as 11 years. Fine. Then the last is like other employees, like Payment of Gratuity Act 1972, it does not apply. Least of the following is exempted, actual amount received. Okay, so this is missed out. Uh, so the next was this pension. Now, as I've told you in the beginning of the session, that this pension is also covered under your salaries, and because it is just the thing that the amount you're receiving, it is received from your employee after your retirement. But now in pension also there are two things, like there is this commuted and uncommuted pension. So commuted and uncommuted pension is like, for example, if your pension is, for example, it is 10,000 rupees, and you commute your pension by 10%. That is, now you will be this, you will, when you commute it, you get some good amount, basically some 10, 15 lakh rupees. It depends on the calculation. There's again another set of calculation. Just understand, for example, if you commute your pension by 10%, that means you are reducing your pension. Now, forever, throughout your life, you will be getting 9,000. Commuting means 10% reduction. Okay. Now your final pension will become 9,000 and you will get 9,000 pension throughout your life. And in lieu of your commuting your pension, you get some good amount of money. So if you, for example, if you need immediate huge chunk of money, and you don't have any other source, you will seek your employer. You will ask them to commute your pension. Okay, you will get a reduction in your salary. Fine. So instead of that, and you will get a reduction, and then you will get huge amount of money. Okay, it totally depends on the calculations. So, pension, it is a retirement benefit and it is kind of a regular payment also, just like your salary, and it is clubbed under your income tax act. So, if it is a commuted pension, so in case of commuted pension, in case of your government employees, this entire commuted pension is fully exempt from tax. Now, in case of non-government employees, amount received in case of commuted pension, it is going to be partially exempted from tax. Okay. So if you're a non-government employee, if gratuity is received, now this is again linked to the gratuity also. Okay. So if gratuity is received, one third of the total pension is exempted. If gratuity is not received, half of the total pension is exempted. Then there is this encashment of earned leave. So for government employees, it is fully exempted. Okay, and for non-government employees, least of the four shall be exempted. Okay, so actual amount received last 10 months. This is basically the least of the below shall be exempted from tax. Actual amount received last 10 months salary, leave encashment on the basis of 30 days leave for each completed year of service and 25. Okay. Then there is something called retrenchment compensation. So compensation received by a workman at the time of retrenchment under the Industrial Disputes Act 1947 or similar acts, rules, or standing order. Okay. So it is exempted in the hands of an assessee to the extent of least of the following. There is this actual amount received. There is this per day salary into 15 into service period in years and or 5 lakh. Okay. So this is like a minimum of these three. It shall be exempted in the hands of an employee. Okay. Then there is something called voluntary compensation scheme. So voluntary compensation scheme is something like when you uh, before your service period ends, you kind of uh, take a you can say retirement from your service. Okay. So voluntarily compensation is like it is an exemption of VRS which is available to employees subject to fulfillment of certain conditions. So these are basically the conditions which you need to satisfy. The employee has served for at least minimum of 10 years and he has attained 40 years of age. Okay. Then exemption of compensation, it should not exceed 5 lakh in his entire lifetime. And the least of following is exempted in this case: amount received, salary of the period left after VRS, 3 months salary for each completed year of service, and 5 lakh. So any amount beyond 5 lakh is taxable under the head income from salaries. Okay. So this is for voluntary compensation scheme. Okay. Now the next topic is your leave travel concession. So what is basically leave travel concession? It is very evident from the name that you're traveling for the purpose of availing your leaves. Okay. So this is of a kind of a component leave travel concession or leave travel allowance. It is a kind of a salary component provided by employers to employees for travel expenses incurred during leave anywhere in India. So it is a very, very popular tax exemption, especially for salaried employees. Okay, so that is leave travel concession. Then what is actually leave travel concession? It allows the employees to claim any exemption for travel expenses incurred for themselves and their family for journeys taken within India during leave. So it does not cover international travel. Okay. So tax exemption rules. So Section 10, subsection 5 of Income Tax Act. So exemption under, just a second. Okay. So there are certain exemptions also which are available in case of your this leave travel concession. So like in the old regime, tax regime, there were certain different exemptions. Now in the new tax regime, there is a slight change. Okay. So if we see our old regime, LTC was exempted up to, you can say, actual travel expense, and there were certain limits to it, like depending upon the whether you are traveling by transport or you're traveling by air. I mean transport, like what is the mode of transport? Either it is a air travel or it is a rail travel. Okay, so it totally depends that what kind of um, mode of transport you have chosen. So on the basis of that, your exemption will be available. Then there is a system of blocks, like exemption for leave travel concession. It can be claimed for two journeys in a block of 4 calendar years. Okay, so the current block is 2022 to 2025. So between these 2 years, whatever, like you can basically take it for two times only. Only two journeys which you can take in number of journeys, but only these two journeys, any two journeys will be exempted in the calendar of in the block of 4 calendar years. Okay. Then the cost of that doesn't mean like for leave travel concession that everything will be your exempted. No, only the cost of travel. It will not include food. It will not include stay or accommodation. It will not include local conveyance or sightseeing. Only and only the cost of travel. And that is also via the shortest route is exempted. So, for example, if you are going to Dubai, now you cannot go to UK first, then go to US, and then you go to Dubai. No, shortest route. Okay, whatever the shortest route. You cannot play with this Income Tax Act. Okay, you have to be very careful. Then, who are the eligible family members? You cannot take your entire extended family also. No, only you, your spouse, and your two children. Up to two children. Okay, so they are the eligible family members. Okay, so as I was telling you that there was something different in new tax regime also. So what is different? So LTC exemption, it is not available under the new tax regime. So employees who choose the new tax regime cannot claim this exemption. In the old regime, LTC exemption can still be claimed if all the conditions are met. Okay. So the thing is, this new tax, like that is with not only with your this leave travel concession. In this new tax regime, a lot of exemptions are not available. They were there in your old tax regime. That is why the taxpayers, they are usually given an option that you choose which of the regimes you want to choose. Okay, old tax regime or new tax regime. Because if you're having a lot of these type of expenses like leave travel and everything, then your old tax regime is good because you will get an exemption over there. However, if you use the new tax regime, you will not get any benefit like this. You will not get an exemption, entire amount will be taxable. So we need to compute like which is better. Okay. So let's see what's there in the slide. Leave travel concession is a benefit provided by employers to their employees, allowing them to claim tax exemption for expenses incurred on travel within India in a block of 4 years. Then, and also two journeys are considered. This is the exemption amount least out of two, like cost of travel, which is economy airfare, first class train fare, or equivalent road transport cost, or the amount reimbursed by employers. This is your leave travel concession. Okay. Now the next is your provident fund. Now provident fund. Now PF are also of various categories. Like one is a recognized provident fund. Then we have unrecognized provident fund. Then we have statutory provident fund. Okay. So what is basically PF? So PF, it is a kind of a, you can say, a retirement savings scheme where both employers and employee, they contribute a portion of salary every month. Okay. So the most common forms are the employees provident fund for private sector employees. So public provident fund, you can say there's something called PPF. Then there is called EPF. Okay. Then there is recognized provident fund also. There is unrecognized provident fund. So recognized provident fund is something which is, you can say, which is approved by the government. There is certain, you know, licenses given to that recognized provident fund. So then there are certain unrecognized provident fund also, which are not approved by the Commissioner of Income Tax. Okay, so recognized provident fund, they are approved by the Commissioner of Income Tax and governed by the EPF Act 1952. So it is more safe. Okay. Then it provides significant tax benefits under the specific conditions. Okay. Then there is this unrecognized provident fund. So it is not approved by the Commissioner of Income Tax. It offers limited tax benefits and amounts are taxable at withdrawal. Okay. Then we have statutory provident fund. So generally applicable to government employees and certain recognized institutions. So they are statutory provident fund and either they are entirely exempted at all stages. Okay. To sum up, so basically we can say that the provident fund, it is a kind of a retirement savings scheme where you are both the employer and employee. They contribute a portion of employee salary every month. Now, there are, as it is mentioned on the slide also, there are different categories of these provident funds. So there are few things. Like first of all, there is this one employee contribution, uh, which is basically the amount which is uh, deducted from the employee salary and deposited into the that fund. Then there is something called employer contribution. So under employer contribution also, the employer makes a matching contribution. Like if the employee was contributing 100, employer will also contribute 100 and 200 will be deposited in the fund. Now, this employer contribution, it is usually tax free up to 12% of basic salary. If the employer is contributing more than 12% of your salary, then the excess will be charged as again as your income. Okay. So the employer contribution is usually tax free, but we need to contribute, like for example, if the permissible limit is 12%, okay, and the employer is contributing 14%, so 2% extra that shall be clubbed in your salary income, that will be taxable as an income. Okay, then whatever contribution is made to these funds from year to year, that fund starts generating interest on that. Okay, so interest income on your this provident funds, it will be basically exempted from tax. Okay, provided the tax rate is not in, you can say it is not more than what is approved by the government. Like presently, I think 8 to 9% is there. So if you're getting interest more than 8 or 9%, which is the permissible limit, then the excess part will be again taxable in your salary. So if you are earning interest less than 8 to 9%, then it will be tax free. Beyond that, it will be tax. Okay. So this is your provident fund. Okay. So this is basically a chart of tax implications and everything. So there is this recognized provident fund, there is this unrecognized provident fund, and then there is this statutory provident fund. Okay. So we have employee contribution. So deduction allowed under section 80C, which is up to 1.5 lakh. So that is a recognized provident fund. Now, under this recognized provident fund, it is exempted up to 12% of salary. Okay. Then in your this interest on employee contribution exempted up to 9.5 per annum. Then it is excess taxable as income from other sources. Then interest on employer contribution, it is exempted up to 9.5% per annum. Excess taxable as income from other sources. Then lump sum consideration, which is withdrawal. So exempt if continuous service of 5+ years. Then exemption not applicable if termination due to ill health, discontinuation of business, discontinuance of business, or other conditions, or transfer to another RPF account. Otherwise, it is taxable. Okay. Then there is this unrecognized provident fund. So for that, no deduction is allowed under section 80C. Now this unrecognized provident fund, it is not approved by the Commissioner of Income Tax. Okay, that is why it is unrecognized. So no deduction is allowed under section 80C. It is not taxable at the time of making contribution. It is not taxable when interest is credited. It is fully taxable as income from other sources. Okay. Then employees contribution, so no treatment like employees contribution and interest thereon. Okay. Then taxable in income from other sources. So interest on employees contribution, it is taxable under income from other sources. Then we have statutory provident fund. So deduction allowed under section 80C up to 1.5 lakh rupees. So that is uh, not like maximum deduction which is there, it is 1.5 lakhs. Then, so there is a thing that the limit for ATC is usually 1.5 lakh. Okay. Now, if your employee contribution is 1.5 lakh, so the maximum amount is 1.5. There are certain other components also which are a part of your ATC. But if the entire limit is exhausted just by PF, then you will not get any other benefit. Okay. So deduction allowed under section 80C is 1.5 lakh. Then employer contribution in case of a statutory provident fund, it is again fully exempted from tax. So this is really good. You can see that the employer contribution, interest on employee contribution, and interest on employer contribution, all of these things are fully exempted from tax. And also, when you get a lump sum amount um, at the time of withdrawal, that is also fully exempted from tax regardless of service period. Okay. So tax-free contribution of the employer shall not exceed 7,50,000. Any contribution exceeding 7,50,000 shall be treated as perquisites. Okay. Then these perquisites, like I've told you that there are certain benefits which are given by the employer apart from your salary, and they're not in the form of cash. Okay. So perquisites are kind of additional benefits or immunities provided by an employer to an employee in cash or kind over and above salary. So they are categorized for tax treatment as follows. So perquisites taxable for all employees, rent-free accommodation, any sum paid by employer fulfilling employees' personal obligation, employer's payment of life insurance premium, annuity for employee, and then medical facility beyond exempted. Okay. Then there are other perquisites like lunch facility, interest-free or concessional loan, traveling, touring for holiday, gifts above 5,000, credit card facility, club facility, use and transfer of movable assets. So these are basically the perquisites. So perquisites taxable only for specified employees. Specified employees refers to director of the company. So these are basically the uh, so what we can do is we can take a break for 5 minutes and then we will continue with our discussion of perquisites. Okay, so we're going to take a break for 5 minutes. We'll continue our this session after 5 minutes. Okay. Okay, so we were discussing about perquisites. Um, so as we've discussed in the beginning of the session, that what is basically perquisites. So perquisites are any sort of non-cash benefit which is offered by your employer in consideration of your services. For example, any sort of car facility which is given. Like there are various types of perquisites. uh, any sort of rent-free accommodation, they have given any flat or any bungalow for you to stay, then any sort of any your personal expenses, any specific servant which is allocated to you for your convenience, all of these are perquisites, right? They give you certain sort of medical facilities which are beyond the exemption limits. So they are perquisites. Okay. So perquisites are additional benefits or amenities provided by an employer to an employee in cash or kind over and above salary. So they are categorized for tax treatment as follows. Okay. So perquisites are taxable for all employees, and rent-free accommodation is also a part of your perquisites. Then any sum paid by employer fulfilling employee's personal obligation, that is also perquisites. Then employer's payment of life insurance premium, annuity for employee, all of these are perquisites. Then this medical facility beyond exemption limits, they are perquisites. Okay. Then there are certain other fringe benefits like lunch facility, interest-free or concessional loan, traveling, touring for holiday, gifts above 50,000, 5,000 rupees, any sort of credit card facility, club facility, use or transport of any movable asset. So these are basically your perquisite. So this is not an you can say this is not a complete list, but we have many other types of perquisites also, which are like any sort of other amenities which are given by your employer to you in addition to your regular salary or wages. Okay, so for example, if your company is giving you company's car, so use of a vehicle owned or leased by the employer for personal or official use, that is company car. Then there is certain sort of any rent-free accommodation or lease accommodation. So if the employer provides a house rent free or at a concessional rate, so that is again a perquisite for you. Then we have any type of interest-free or concessional loans. So loans given by the employer at a rate of interest lower than the prescribed rate. So that is again interest-free or interest-free loan. Then we have furniture, gas, electricity, and other supplies. So provision of welfare amenities, that is a common type of purchase. Then there are other things like club membership fees, which are paid by the employer. Then there is this medical facilities, then contribution to pension funds or any other funds over and above statutory limits. Okay. So then there are free or subsidized food or drink. So these are common types of perquisites. Then there are certain valuation of perquisites. So Income Tax Act prescribes specific rules for valuing each kind of perquisites. For example, there is this rent-free accommodation which is valued based on employer's cost or a percentage of salary. So there is company car perquisite, which is valued based on the cubic capacity and use. Okay. So it can be basically, uh, it can be for official or personal use also. Then any interest on concessional loan also. So the difference between the market interest rate and the rate which is offered by the employer. So any difference, that the difference is going to be your perquisite amount. Okay. Then there are certain perquisites which are exempt only under certain conditions, like their medical facilities up to a certain limit, transport allowance wherever applicable, then leave travel concession in some cases, they are also exempted. Then personal use of mobile phones and internet is exempted up to a reasonable limit. Okay, so all of that is exempted or they are taxable perquisites. Okay, so as I've told you, there are so many perquisites. So for rent-free accommodation, we are basically going to, they are usually taxable at some 15% or 10% or 7.5 of 7.5% of salary, and that percentage is totally determined on like in which city you are living. Whether in your huge expensive city, then it is going to be your taxability will be 15%. So it totally depends, like for the rent-free accommodation, that in what kind of city you are given living. Okay, so it can be city, it can be cost, it can be your salary. Okay, so perquisites taxable only for specified employees. Just give me, hold on. We were on this. Hmm. So perquisites taxable only for specified employees. Now the thing is, if you see any organization, there are certain category of there. First of all, there are certain. Let's understand who are specified employees. Okay, so if you see any organization, there are certain employees who are considered as specified employees. Now, how will you determine that a particular employee is a specified employee? That first of all, that he, she is a director in the employer company. Then that person, he is um, allowed, or he is basically holding 20% or more of the equity power in the employer company. Then his salary income, it exceeds 50,000 for the previous year. So that is again your specified employee. So an employee is considered a specified employee if any of the following conditions are met, like he's a director in the employer company, he holds 20% or more equity power in the employer company, and his or her salary income, it exceeds 50,000 for the previous year. Now, why being a specified employee matter? Why does it matter? Because like some perquisites, often they're non-monetary or they're of very significant value. They are taxable only if they are received by specified employees. For example, services of a domestic servant hired by the employer. Okay. Then free or concessional education for the employee's family. Then certain amenities, for example, gas, electricity, water expenses paid by the employer for the employee's house. So there are certain amenities. Then these are not taxed in the hands of non-specified employees. So these matter because of these reasons. Okay, these perquisites, because they are not taxed in the hands of non-specified employees. They are taxed differently in the hands of the specified employees. Who are those specified employees? Those employees who are usually on a senior level, like either the director of the employer company, they hold 20% of the voting power, they have a significant say in the company. They are the top employees or top officials in that company. Okay. Then what kinds of perquisites they are taxable only for specified employees? For example, sweat equity shares, or you can say employee stock options, ESOPs. They are taxable only for specified employees. Then there is this value of free or concessional educational facilities. So that are again for specified employees. Then supply of gas, electricity, water, or amenity by the employer. Okay. So supply of gas, electricity, water, amenity by the employer, they are again perquisites which are taxable only for specified employee. Then your the servants provided by the employer, for example, gardener, any cook, driver, all of these are servants provided by the employer. Then we have interest-free concessional loans. Okay, so they are again these are perquisites which are taxable only for specified employees. Okay, so Specified employees, basically, why it is focused so much, because employer company, it wants to bring more tax, like tax transparency and liability for perquisites, like that it is a really bad scenario where the top employees are taking up a lot of funds or lot of these perquisites from the company, and it is not being taxed because no one is aware. So basically perks are basically taxed so that to bring more transparency that these employees are getting these many benefits. Okay. So these are specified employees. So who are specified employees? They refer to directors of the company and employee holding more than 20% equity voting power. Okay. Then employee with salary, like excluding non-cash benefits exceeding rupees 50,000. Okay. Then facilities taxable for specified employees only, like a car facility, which is provided or maintained by the employer. Then education facility, which is over 1,000 rupees per child per month. Then your domestic servant facility, that is servant salary paid by employer. Then utilities like light, water, and gas provided at residence. Then transport facility other than office transport. Okay. Then these are other types of perquisites which are taxable for all employees. Okay. So all, like we all know that in offices they have canteens and messes and they have eateries. So all the refreshments, just a second. So we were actually discussing perquisites. Okay. So these basically these are perquisites which are taxable only for your specified employees. Then these are perquisites which are taxable for all employees. Okay. So refreshments, snacks provided during office hours, employer provided laptop, computer for work, official use of mobile, telephone or internet, then employer's contribution to recognized provident fund, then medical reimbursement up to specified limit, then leave travel allowance subject to conditions, interest-free concessional loans up to threshold, then gratuity, then uniform allowance, then recreational facilities, and then group insurance claim. There are various types of perquisites which are taxable for all employees. Okay, so while many perquisites are taxable only and only for specified employees, but there are a lot of perquisites, as you can see in the list on the slide, that they're taxable for all employees, regardless of your, you can say, designation, your level of, like level of hierarchy in this organization or shareholding. So these rules apply to both private and government sector employees unless specifically exempted. So we have rent-free or concessional accommodation. So if your employer provides you with a house, either free or at a reduced rent, then the taxable value is calculated as per the rules laid down. It is basically based on the city population, salary, and employer type. So both government and non-government employees are covered in that. Then we have taxable value, like usually a percentage of your salary or actual cost to the employer reduced by the any rent paid by the employee. So that is a rent-free or concessional accommodation. Then we have employee contribution to recognized provident fund. So employer's contribution above your 10% of salary, which is your basic or DA, to a recognized provident fund, it is taxable as a perquisite for all employees. Then interest credited above the notified rate, like above 9.5% per annum, it is also taxable. Okay. Then any sort of sweat equity shares or ESOPs. So if an employer provides ESOPs like employee stock option plans or sweat equity shares, the excess of the fair market value over the price paid by the employee, it is taxable, and perquisite income on the date of allotment exercise even for non-specified employee. So ESOPs are again, um, they are taxable, but up to a certain, beyond a certain limit. Okay. Then there are, you can say, there are these medical reimbursements. So medical reimbursements are also, they're again taxable up to a certain limit only, like whatever is the plan. Okay, whatever is the insurance plan which is taken up by your company. Okay. Hmm. Now, when your employer gives you uh, rent-free accommodation, like many organizations, they have their own, you can say, flats or their accommodations, which are handed over to the employees for their living purpose, and they're charged a minimal amount for that. But that part is taxable in your salary. Okay, it is part of your salary also, but differently. Like for government employees, the rule is different. For your non-government employees, the rule is different. Okay, so rent-free accommodation, you can say it is, you can say, uh, accommodation which is provided by an employer, and it is rent-free for you. You don't need to pay anything separately for that. But yes, whatever is the value of that service, or you can say, if, for example, if the rent for a similar property is 25,000 per month, so you are ideally eligible for including that amount in your salary, and tax will be charged in that. Okay. So rent-free accommodation provided by an employer, you can say that it is still considered as a part of income from salary for taxation purpose. Okay. So this is applicable to both government and private sector employees, and it is not applicable to employees of the Reserve Bank of India or certain judges and United Nations employees as per specific exemptions. Okay, so the general principle of this over this is that the taxable value is based on the type of employer. First of all, what is the type of the employer? Then, what is the salary level? Then, the location of the accommodation, and whether the property is owned or leased by the employer. Okay. So the valuation rules are specified under Rule 3 of the income tax. So these are basically the general principles which are there while doing valuation of your rent-free accommodation. Okay. So then this valuation, it becomes slightly different for a non-government employee. So for a non-government employee, there can be, first of all, two scenarios, that if the accommodation is owned by the employer. Secondly, if the accommodation is rented by the employer. Okay. So if the accommodation is owned by the employer, then again there is a category that in which city. If there is a city with a population exceeding 25 lakh, then it is going to be 15% of your salary. Okay. The valuation will be 15% of your salary. If there is a city whose population is between 10 to 25 lakh, then it is going to be 10% of salary. Okay. Then other location, then if it is 7.5% of salary, other, for example, if it is exceeding 25, it is going to be 15%. If it is 10 to 25 lakh, it is going to be 10%. Then any other, like less than 10, okay, it is going to be 7.5% of your salary. So salary includes basic salary, dearness allowance, bonus, commission, and all taxable allowances, but excludes employers' PF contribution and exempt allowance. So if the accommodation is leased, rented by the employer, so the taxable value is the actual rent paid by the employer or the percentage of salary as above, whichever is less. So for government employees, the taxable value is the license fee as determined by the government minus any rent paid by the employee. Okay, so that is for government employees. Then reduction for employees' rent payment. So if any employee pays any rent to the employer, that amount reduces the perquisite values accordingly. Okay. Then we need to pay certain documents to prove this. So if the accommodation is furnished, then we have to prove that it adds up to the 10% of the cost for furniture also, okay, to the taxable value. So now when we are talking about rent-free accommodation, we have to see multiple things. Like we need to see what is the category of the employee, what is his salary level, in which city he is living, what is the population of the city, and whether the property is owned or leased by the employer itself. Okay. Now, if that flat is furnished flat, okay, we will add something extra to the taxable perquisites. So under your this rent-free accommodation, we need to see a lot of factors so that you're not paying extra tax or you're not evading certain taxes. Okay, so it is very important to carefully assess it. So let's see. Um In case of government employees, valuation follows rules framed by the government. In case of non-government employees, accommodation owned by employer. In cities with population over 25 lakh, 10% of salary. In cities with population over 10 lakh and end up to 25 lakh, it is 7.5% of salary. In cities with population 10 lakh or less, it is 5% of salary. And accommodation leased by employer. So taxable perquisite is the lower of actual rent paid by employer or 10% of employee's salary. Okay. Then if it is a rent free furnished accommodation, it will value as above, like 10% of the cost of furniture if owned by employer or actual higher charges paid by the employer if furniture is higher. Okay. So over here, the salary includes these benefits like we include your basic pay, we include the dearness allowance if it is part of retirement benefit, then bonus, commission, fees, and any sort of other taxable allowance that will be covered as a part of your salary. Okay. Then monetary payments from other employers. So for calculating this rent-free accommodation, the salary will be including all of these things, basic pay, DA, commission, bonus, all of this. Okay. Then we have concessional accommodation. The taxable value is reduced by the amount recovered from employee. Okay, so that is your um, concessional accommodation. Then comes the concept of exemptions of accommodation policies. So exemptions, mm, let's see, some, okay, so that's covered. Fine. I thought that something is missing. Okay, so we were talking about this valuation of rent-free accommodation and now the exemptions of accommodation facilities. So what happens is that many times there are certain categories which are exempted also. Okay, so usually what happens is uh, these exemptions, they are given to certain category of employees. Okay, so certain categories like first of all, there can be employees of the Reserve Bank of India. Okay, so RFA, like this RFA, basically rent-free accommodation, it provided to RBI employees. It is fully exempted from tax. It is not clubbed in their salary to show as a perquisite. Okay, then for judges of High Court and Supreme Courts, so accommodation provided is not treated as a taxable perquisites. Okay, so judges of High Court and Supreme Court also, they also it is not treated as a taxable perquisite. Then employees of the United Nations also. So the value of rent-free accommodation provided is exempted from income tax as per specific provisions. Okay. Then officials of parliaments and certain government officers. So when allowed free accommodation due to their possession, exemption is provided under relevant notifications. Okay. Then valuation exemption. So accommodation provided at work site. So if the employer provides accommodation at or near a work site, for example, any construction site, any mining location, and that accommodation is temporary, or it is for a group of staff or any low paid employees and not of a high standard. So the value of such accommodation may be exempted if it is efficiency of work and not as a personal benefit. Okay. So accommodation, any sort of accommodation which is given outside India also. So for Indian citizens working outside India and receiving rent-free accommodation provided by the you can say the government as part of their employment, so the value fully it the for the value it is fully exempted from tax. Okay. Then reduction in taxable value. So even where this rent free accommodation is taxable, any sort of rent paid by the employer, paid by the employee to the employer for accommodation purposes, it is again deducted from the taxable value of the perquisites, and that will eventually reduce the tax liability. Okay, so most employees um, they find that this rent-free accommodation is taxed as a perquisite under the rules, but special categories like judges, RBI, UN, Parliament, they enjoy full exemption. Okay. Then we have this worksite accommodation like at a maybe at a very remote project site. It is also typically not taxed if primarily for work purposes and basic in nature. And we always check the employees category before computing tax on rent-free accommodation. Okay. So accommodation provided in remote areas such as mines or oil rigs is exempted from tax. Then accommodation provided for the performance of duties, for example, accommodation for security personnel or caretakers is exempted from tax. Then accommodation provided is accommodation provided in a hotel for up to 15 days during transfer is exempted. Then double accommodation due to transfer, that is accommodation at both old and new places exempt under specified conditions. So for the first 90 days, the taxable amount is the value of the accommodation with the lower valuation. And after 90 days, the aggregate value of both accommodations is taxable as per valuation rules. Okay. Then let's see the valuation of ESOP or certificate shares. So ESOP states that when an employee receives securities at predetermined prices, while set equity shares means shares issued by the employer for consideration other than cash. So the taxability of ESOP equity shares arises when the same is transferred to an employee. So I think many of you must not be aware of what are basically ESOPs. So ESOPs or sweat equity shares, they are basically, you can say, equity shares which are given by the companies. They're off to the employees first, okay, then to the general public. So ESOPs are popular benefit in you can say in Indian or your you can say multinational companies also. The company basically offers the right to buy the company's shares on a priority basis. Okay, so the shares are offered to the employees of that particular company, and then they are offered to the general public. Okay, so in India, it is a very, very popular benefit which Indian companies they offer to their employees. Uh, that is basically a right. They are just offering a right to buy company shares at a predetermined price. While these ESOPs, they can be a very, very powerful wealth building and incentive too. So it is definitely very crucial to understand the tax implications and the under Indian law. Okay, so that is the thing. Then taxability, like there are various stages in which that ESOP is taxed. So the tax treatment of ESOPs, it is basically two stages mainly. So at the time of exercise, when options are converted to shares, so the difference between the fair market value on the date of exercise and the exercise price paid by the employee, it is taxable as a perquisite under the head salaries. Okay. So this value is subject to TDS. Okay. Tax deducted at source by the employer and is reflected in Form 16. Okay. For example, if fair market value is 1000 rupees per share. Okay. And your exercise price means at a price which you can buy the share. That is exercise price. Okay. That is 600 per share. And you exercise some 100 shares. Okay. Like the exercise, the fair market value, like the market value of that particular share is 1000 rupees per share. And your exercise price, like it is 600 per share. And you exercise some 100 shares. So taxable perquisites is 1000 minus 600 into 100. Okay. So 40,000 rupees. Okay. So that is a thing. Then at the time of sale of shares. So when we later sell these shares, the gain or loss is subject to capital gain tax. So the cost of acquisition is considered to be the fair market value used for perquisite calculation at the time of exercise. So the capital gain, short term or long term, it will depend on the period you hold the shares after the exercise. Okay. So the capital gains will be depending upon the period you hold the shares after exercise. Then we have short term, or which is like if they are held for um, less than 12 months for listed shares. Then long term, it is held for more than 12 months for listed shares. Okay. So it we have to assess that whether it is long term or short term. Fine. Then there are certain more things like there are certain startups which give ESOPs. So few startups, they are recognized as having a special facility uh, for by the Income Tax Act under some special exemptions. Okay, so over there you can basically defer the tax on the ESOP perquisite. Defer means like you're not paying the tax today, maybe you can pay the tax at a later stage. Okay, so that is called deferred. So in that case, for there are certain eligible employees, like the payment of tax at the time of exercise can be deferred up to 5 years. Okay, so or till the till they exit from company. Okay, so that is basically employees stock options, and there are various, I mean, provisions related to it. Okay, so who are primarily taxed in case of ESOPs? So it is the employees. Okay, all employees, not just specified employees, are subject to tax on ESOPs as perquisites, and it applies whether the shares are granted by an Indian or foreign company. Okay, so with rules varying for global taxations. Okay, so they are taxed. Then there are certain important points which I would like to reflect on this thing. Like ESOPs, they are not taxed when they're granted or vested to a particular employee. That it is taxed only when that employee exercises that option. Okay. So the tax will only arise when the employee will exercise that ESOPs and he will buy that ESOP. Okay. Then only these ESOPs will be taxed. Then employees should plan for the cash flow impact since tax at exercise arises even before shares are sold. Okay. Or liquidity risk. So TDS is deducted on the perquisite value by the employer. Okay. So that is a thing. Then perquisites tax at exercise. Okay. So capital gains tax at sale both may have substantial impact on net benefit. Okay. So they are basically ESOPs. Okay. Then we have old and new tax regimes. So the taxation of ESOP perquisite is the same under both regimes. Okay. like our slab might vary based on the total income and the selected regime. Okay, so we can use the deferral benefit also, like we are eventually going to pay the tax only when a certain criteria is satisfied. Okay, so there are few things to sum up. We can say there are few things like which are important to understand in case of ESOPs. First of all, exercise options. Exercise options means like it will be taxed only when a particular ESOP will be exercised. Then there are certain, uh, you can say there's a certain fair market value. Okay, so fair market value is the current market price. And there is this exercise price. Exercise price is the amount which a company says that you need to pay this much to an employee. So exercise price is only for the employees. It is not for the externals. Okay. So there are few basic things only under your ESOPs. So ESOPs states when an employee receives securities at predetermined prices, while set equity shares means shares issued by the employer for the consideration other than this cash. The taxability of ESOP or set equity shares, it arises when the same is transferred to an employee. Then we have taxable value, that it is equal to fair market value on the date of exercising the options minus exercise price into number of shares. Okay. Then there is this lunch. Okay. Then there is this lunch facility which is given by an employee. So as we all know that there are companies, majorly all the companies, they give lunch facility to their employees. So now when the lunch facility is given to the employees, um, either the company charges a very minimum amount, okay, and if they don't charge, the cost, a very minor amount is added to their salary as a perquisite. So if an employer provides the lunch facility during office hours, then exemption shall be given to an employee up to rupees 50 per meal. So any amount borne by the employer in excess of rupees 50 per meal shall be taxable in the hands of employee. Okay. So tea or snacks provided during office hours shall be exempted. So also any lunch facility provided in remote areas shall not be chargeable to tax. Okay, so that is your lunch facility. So that is also kind of perquisite which is given by the employer to its employees. Okay. Then there is this interest-free or concessional loan. So the taxability of loan provided to an employee during the previous year shall be calculated as per the prevailing interest rate in State Bank of India on the first day of the previous year. So the interest amount has to be calculated on the outstanding balance on the last day of each month. So if an employee has actually paid any amount against loan, then that amount shall be reduced from the taxable value. Okay. Then there is this use of movable asset. So asset used exclusively for official purposes. Okay. So value of taxable facility shall be nil in that case. Then value of laptops and computers for any purpose. Okay. So value of taxable facility will be nil in that case. Then use of any other movable asset owned by employer. So in that case, value of taxability will be 10% of the cost of asset. Okay. And use of any other movable asset taken on rent by the employer. So value of taxable facility will be actual expenses borne by the employer. Okay. So these are basically the amounts which are basically taxed when a movable asset is involved and it is provided by your employer. Then there is a car facility. So car owned by employer. So car used for official purpose, it is nil. Then car used for professional purpose. So entire expenditure incurred by the employee plus 10% of the actual cost. So that is your value facility. Then car used for both for official and personal purpose. So all expenses, so these are basically scenarios, two scenarios, okay? And this is basically on the capacity of the car, okay? So all expenses are met by the employer and the car is 1.6 cc, then it is 1800 per month. Then car exceeding 1.6 cc, 2400 per month. Then personal expenses are met by the employer. So car up to 1.6 cc, it is 600 per month. Okay. Then car exceeding 1.6 cc, it is 900 per month. So if the facility is provided along with driver, then rupees 900 per month shall be added to the amount mentioned above. Okay. Then car owned by employee, but expenses reimbursed by employer. So if the car is owned by the employee and the employer reimburses fuel, maintenance, or driver salary, then tax implications are is under. So car used for official purpose, it is nil. Then car used for personal purpose, it is entire expenditure borne by the employer. Then in case of car used both for official and personal purpose, cubic capacity of car up to 1.6 cc. So in that case, actual amount borne by the employer less rupees 1800 per month. So that is one thing. Then cubic capacity of car exceeding 1.6 cc, it is actual amount borne by the employer less 2400 per month. Okay. So if facility of driver is also provided, then rupees 900 per month shall also be deducted along with 1800 rupees or 2400 per month. Okay. So that is one thing. Then educational facility. So educational institution is not owned by employer. So value of perquisites shall be the actual expenditure incurred by the employer. Then in that case, educational institution, if it is owned and maintained by the employer, then taxable value of perquisite shall be the cost of education in a very similar education near in that particular locality. So basically the point is to bring the fair market value, okay, or the cost of that service presently in that locality. Okay. So in that case, no tax implications when cost of education per child does not exceed 1000 per month or free education facilities provided to children of all employees. Okay. Then perquisites exempted for all employees. So medical treatment in government hospitals and in hospitals which are owned by the employer are exempt from tax. Then treatment taken for specified diseases in notified hospitals is also exempted. Okay. Then premium paid by the employer for health insurance under a scheme approved by the government is exempt. Okay. Then transport facilities provided by an employer engaged in the business of transportation to his employees, it is exempted from tax. Okay. Then perquisites exempted for all employees. So expenses incurred on a telephone, including mobile phone provided by the employer for official and personal uses, they are exempt. So any kind of perquisite which is provided for official duties, such as you can say laptops, computers, or other tools required for performing official tasks, they are exempted from tax. Then the value of uniforms provided by the employer required for official purposes, it is exempted from tax. Then free or subsidized refreshments provided during office hours, they are again exempted, provided they are available to all employees. Then we have educational facilities, which is provided to the children of employees in schools run by the employer, they are again exempted. And if it is up to 1000 per child per month. Okay. So this is about perquisites which are exempted for all employees. Okay. Then there are certain deductions from salary. So if we see the deductions from salary, the main thing is your this standard deduction, which is I've told you like earlier it was 50,000 and now it is 75,000. Okay, so basically, these deductions, like from your salary, it reduces the taxable salary income, thereby lowering the tax liability of salaried individuals. Okay, so the first thing is the standard deduction, which is 75,000. So standard deduction of 75,000 is allowed for from salary income for financial year 24-25 onwards for all salaried individuals and pensioners. Okay. So this deduction is available under both old and new regimes. So it is a flat deduction. It is a flat deduction that does not require any proof or bills. So for example, if your gross salary is this 10 lakh, so the taxable salary reduces by 75,000 just by this deduction. Okay. Then we have professional tax. So professional tax paid by the employee is deductible from salary income under section 16. Okay. So usually the employer deducts professional tax from the salary and the employee can claim this deduction while filing returns. So the maximum professional tax is some 2,500 annually. Okay. Then there is this allowance for entertainment also, which is given to the employees. Like entertainment allowance, basically, it is like there is again a pattern for that. So for entertainment allowance, I think it is some 20% of basic salary. And then let me see, it is 5,000 least of the following, which is 5,000, 20% of basic salary, and actual entertainment allowance received. Okay, so only this is specifically for government employees. Okay, so this is allowed as a deduction only in case of government employees and to the minimum of these three factors: 5,000, 20% of basic salary, and actual entertainment allowance received. Okay, then we have conveyance allowance. Okay, so for government employees, conveyance allowance up to 1,600 per month, that is 19,200 annually. Then they get no specific deduction except standard deduction. Okay. So while these are deductions from salaries, but from your gross income. Okay. So they significantly reduce taxable income and are often associated with salaried individual. Then we have section 80C. So deduction up to 1.5 lakh per year on investment like employees provident fund and LIC and all of that, they are covered under your section 80C. Okay. So with this, I think your entire unit, it came to an end. We have covered almost every component of your salary. Okay. So I would request all of you to please go through you can say, your module also. And if you face any queries, any doubts, you can definitely uh, bring your queries in the next session. Okay. And I'll be more than happy to take up your queries. So that's all for today's session. Thank you so much. And we're going to meet in the next session and we'll probably start income from profit and gains from business or profession. Okay. Thank you so much. Have a nice day. Bye.